Take two people, same company, same job, same salary. One retires December 31st, and the other keeps working through January and retires February 1st. So who made the smarter call? The answer depends almost entirely on 5 factors that most people rarely check before they give notice. And those 5 factors are what this video is about. By the end, you'll have a concrete checklist for your own situation and be able to better understand why December 31st is often worth a closer look. I'm Dwight Detloff. I'm a CPA and CFP professional, and I help people make the tax and financial decisions that come with retirement. So number 1, pension timing. If you have a pension, start by pulling your pension documents or ask HR department or plan administrator, because pension rules can vary significantly from one plan to the other. And so the question isn't, when do I want to leave? It often becomes, when does my pension actually start paying? Some plans will start on the first of the month after the last day of work. So if you're retiring December 31st, that could mean a January 1st pension start. Other plans have some sort of waiting period. Others might start on the first of the second month after separation. And some pension formulas may give additional service credit depending on exactly when you retire. And so that it could affect your actual monthly benefit permanently. So there's no really universal rule here. I've seen plans where the retirement date mattered quite a bit and others where it really didn't make much difference in the calculation. So the only way to know is to pull the document or talk to the benefits office. So if I separate on this date, when does my pension start? And am I leaving any additional service credit on the table? Answer in writing if you can. All right, number 2, unused PTO and vacation. If you're retiring with accrued vacation or PTO, the timing of that payout can matter for taxes, and it can matter more than people expect. So here's a common situation. Someone retires December 31st and receives their unused vacation payout in January. And compare that with somebody who retires in March and receives a large PTO payout on top of 3 months of salary. These dollars are now stacking together in the same tax year. And so one thing worth clarifying here, your employer may withhold federal tax using 22% supplemental wage rate on a lump sum PTO payout. But that's a withholding rate. It's not necessarily your actual tax rate. So your real tax liability depends on everything else happening during the tax year. And don't assume the reverse either. Numbers and see what it tells you whether getting that payout into a lower income this year or next year could be valuable. And remember that state law and your employer specific policies can also determine whether unused vacation gets paid out even at all. So confirm those details before building out your retirement plan around them. All right, number 3, health insurance and the bridge to Medicare. For anyone retiring before age 65, health insurance can be one of the most financially significant parts of choosing a retirement date. So when you leave your employer, you may have COBRA rights that allow you to continue your employer's health plan. Full premium yourself, plus typically a small administrative fee if your employer was very generous with their health benefit. And your income after retirement, you might qualify for premium tax credits that reduce the cost. And we'll get to that in just a second. Important Medicare issue here. So if you've delayed Medicare Part B because you've had coverage based on your current employer, you generally have an 8-month special enrollment period after that employment or job-based coverage ends, whichever happens first. So COBRA does not automatically extend that deadline. So waiting until COBRA runs out before dealing with Medicare can potentially create a coverage gap or late enrollment penalty. That's a timeline you want to plan around carefully. And before we get into the tax planning piece, if you want more videos about the tax and financial decisions that come with retirement, subscribing is the easiest way to catch the next one. Your first lower income tax year. This is the factor I think a lot of people underestimate. And in my experience as both a CPA and financial planner, it can be one of the more valuable parts of the retirement date decision. So think about what happens here, right? So you spent your entire career earning a salary and potentially sitting on a reasonably high, and then you retire. And suddenly your taxable income may drop significantly. Maybe Social Security hasn't started yet. Maybe required minimum distributions are still a few years away. Maybe you're primarily living from savings and investment. And the cleaner you can make that window, the more useful it can become. It creates a really clean break. So starting January 1st, you potentially have an entire calendar year without salary income. Your income might consist of a pension, Social Security, portfolio withdrawals, or some combination of those. But your taxable income could be meaningfully lower than it was while you were working. So what do you do with that room? Well, there's a few things. First thing that comes to mind, Roth conversions. You may be able to convert some of the money from traditional IRA to a Roth IRA and pay tax at a lower rate than you would have during your working years, and potentially at a lower rate than you might face later when RMDs, required minimum distributions, force money out of those accounts whether you need it or not. Second, capital gain harvesting. Filing jointly in 2026, and this changes, the 0% long-term capital gains bracket extends up to $98,900 of taxable income. So if your taxable income is low enough, some of your long-term capital gains could potentially be taxed at 0% at the federal level anyway. Exactly how much tax fits or how much gains fits into that bracket depends on other taxable income. But for somebody sitting on appreciated investments they've been reluctant to sell, this is really something worth looking at. Third, ACA premium tax credits. If you retire before age 65 and buy health insurance through the marketplace, your income can affect the amount of premium assistance you receive. So Roth conversions, capital gains, health insurance strategy, those all interact with one another. So you don't want to optimize each decision separately. You want to model all of those together to see how they interact. Okay, now compare someone retiring December 31st with somebody retiring, let's say June 13th. That person retiring in June still has 6 months of salary on that year's tax return. They may have some room for these strategies, but their salary has already consumed up quite a bit of their tax bracket that we're trying to manage around. Retiring December 31st doesn't really give you a low income planning window in that year, but it can give you something to potentially even cleaner, which is the following calendar year without any wages or not much, depending on PTO, payout, etc. And that's why I like to look at the retirement timing across sort of 2 different tax years rather than treating it as one date in isolation. And finally, number 5, employer-specific dates and benefits. Before you give notice, take a look at your employer's benefit calendar, because retiring a few weeks too early can sometimes be take an annual bonus, large bonus in February based on prior year's performance. Could retiring December 31st mean forfeiting that bonus? Would working another month allow you to keep it? So you need to know that. Some employer contributions have year-end employment requirements, hours of service requirements, or other conditions you need to satisfy. Retiring shortly before either one of those dates could potentially mean leaving employer contributions behind. And then there's stock compensation. If you have restricted stock units or stock options, when is your next vesting date? Weeks means keeping shares you would have otherwise forfeited. And what about retiree medical benefits? Some employers require you to meet very specific age and service requirements before becoming eligible. So if you're really close to one of those thresholds, find out exactly the date you qualify before making your retirement official. And of course, none of this means you should stay in your job longer than it makes sense for but you should be able to go in with eyes wide open and know what you're giving up before you make that decision. Universal best month to retire. There may absolutely be some better months for you. Your pension commencement rule, your PTO and vacation payout, your health insurance bridge, your first lower income tax year, and your employer specific benefit, December 31st and January 1st. But whether it's the right date for you depends on how all of those pieces fit in together. The important thing is to kind of run the numbers before you give notice. And if you'd like to help doing that, I'd be glad to talk. You can book a free intro call through the link in the description. Thanks for watching, and I'll see you in the next video.